you ask yourself, should I invest in fashion? Should I invest in deep tech? Should I invest in software? Should I invest in digital services, as you said? And so we ask ourselves the question, and the response is very weird because nobody is really looking at the numbers. We should be guided by numbers. So if you take 20 years of IPO of digital services, and you look at all those IPOs, in order to go public, in average, a digital service company needs to raise 1.2 billion in average. And at IPO, in average, they do X return, which is very good. Now, an IPO winners are usually the winners. Those are the best companies. So that's what you can expect if you do very well. On software, it's 450 million to go public, so 3 times less expensive on a software company, which is intuitively right because you don't need to create a brand, and digital services are about consumers and software is about B2B. So 450 million, and you do 6. So in a way, if I'm an investor with a brain, I should do only that because I can do 3 companies instead of 1. And I do a better multiple of exits. So I'm kind of having a much better outcome in my funds. And then you go at hardware. And hardware was a revelation for us because in hardware, you need still 480 million to go public. So not much more than software at the end of the day. And I can explain you why. And the multiple at exit are 16x IPO. So we are in a world where everybody is explaining us hardware is it doesn't pay off, you should not go there, and so on. And we keep hearing that. And in reality, it is the best returner, and it's very capital effective. And why do we not read those things? Of course, we have the French culture, which is saying that industry is bad because, it's not, we are in a world where worker is a bad word and so on. But it's not only that, it's also because it's a little bit front-loaded. I must say that, the reason for hardware to be a little bit less popular is that the investment is front-loaded. You cannot invest progressively. In internet services, you can invest, 200 at a time and expand worldwide. In hardware, you build your business and you're worldwide day one. So it's slightly more complicated. In software, you invest a lot in salespeople, which is very shallow in terms of safety and so on. It's very risky. In hardware, you don't need brilliant salespeople. So I'm sorry for the salespeople in hardware who are listening here, but you are selling something you can touch. Come on, it's easy. The unit of commerce is not intellectual property somewhere in the cloud, which you cannot touch. Here, it's something, you have it, you touch it, and you sell it for a dime. That's simple to sell. So hardware companies are asset heavy, they are IP heavy, and they sell well because what they sell lasts. Now the story is becoming very different. After this AI tsunami, software is in trouble because you see what's happening. The hyperscalers are increasing their price and putting pressure on the profits of SaaS companies. So where you were expecting 80% gross margin, now you do 60. So your profits are gone. And on the other hand, your multiples are going from 6 times your annual recurring to 3 times your annual recurring because nobody cares anymore about your technology. Cloud code is going to replace it. So those guys, in a matter of 3 years, from rock stars with a kind of a perfect recipe to become rich, became commodities with low profits, while hardware didn't change a bit.